The third thing that you can consider investing in if you want to build wealth is in businesses. Now, when it comes to businesses, there's two different ways that you can do this. One can be in your own business, and the second can be in somebody else's business. My number one place where I invest my money is into my own businesses. Now, I don't really consider this a traditional investment because when I invest my money into my own businesses, like into Briefs Media, which is my newsletter company, that is an active investment because I run that company. I am the CEO of that company. I work every single day to operate and manage Briefs Media. So when I invest money into Briefs Media, I'm working to actively grow that money. And that is another form of investment. It's a way for me to now put my money to work, not into real estate, not into stocks. In fact, over the last couple of years, I've been actively investing less money into real estate, less money actively into stocks. That way I have more money to invest into my own company because I want to grow my own company. Because when you invest your money into stocks or real estate, you're trying to get, again, a 7 to 10% return on your money, which is a great return over the long term, especially as a passive investor. But when you're investing your money into your own business, there's no limit to the types of returns that you can get. So financially, you can get higher returns. It comes with more risk, but then you're also able to grow whatever it is that you're working on. And for me, Briefs Media has a lot more upside right now, which is why I've been investing a lot more aggressively in that. Again, it works for me because I am an entrepreneur. I am that type of person. And so I'm willing to accept that risk that if the company goes bankrupt, I will lose all the money that I invested into it and all my time that I put into it. But I'm willing to take on the risk. If you're not an entrepreneur, you don't have a business idea that you want to invest in, that's okay. You can also invest in other people's business ideas. You can invest in startups. And this was something that I started doing around the pandemic time because I started seeing that investing in startups has become much more accessible thanks to something called crowdfunding. There's new regulations that allow regular people like you, me, anyone with as little as $100 to invest in crowdfunded or startups with small amounts of money. And with this, you also have to understand that when you invest in somebody else's startup, you will probably lose money. The statistic is like 8 to 9 out of 10 startups will fail or go bankrupt within the first 5 years, meaning most of the startups that you invest your money into will lose money, period. You have to understand that when you go in. But the goal isn't to lose money always. The goal is that when you make money that one time, it should hopefully make up for all the losses. But it's a whole different skill set and a whole different type of work and risk, I guess you can call it. But something for me that I really enjoy because I love working with entrepreneurs. I am an entrepreneur myself and I have built a platform, fortunately, where I can also help grow entrepreneurs. I can help provide awareness to companies that I've partnered with. So for me, I love this type of startup investing, although I don't do as much of it as maybe I would like because, again, I'm focused on building my own brand, but I have invested in a handful of different startup companies. Now, a few platforms that you can consider using, and again, I'm not sponsored by any of these companies. I'm just letting you know who they are. Number one is WeFunder. Quick disclaimer, I am an investor in the WeFunder Corporation. Number two is Republic. Number three is Start Engine. These are three different platforms where you can go and invest in startups. Now, again, the way that you get paid here is if the startup that you invested in either goes public or it gets acquired. Goes public meaning it trades on the stock market, or gets acquired meaning it gets bought out by another bigger company. If the company that you invested in doesn't get acquired, it doesn't go public, you might never see that money again. If the company that you invested in goes bankrupt, you will never see your money again. So it's very risky, but it has a lot of upside because it's like investing in a new company in the very early stages of its life. And so you can have a lot of upside, but a lot of risk. And if that's something you're interested in, it could be a piece of your investment portfolio. Probably don't want to make it a huge chunk of your investment portfolio, especially if you're just starting off, but it can be a small little piece of your investment portfolio. It's kind of a fun way for you to invest in smaller startup entrepreneurs as long as you're willing to understand the risk.